Hello everyone. I'm making this video today. I've just come back from the um, annual Tamil Nadu Investors Association or TIA conference, Bulletproof Investing. It was a fantastic event and graced by one of India's largest individual investors, Rajiv Khanna, who is the husband of Dolly Khanna. I mention this because Dolly Khanna's name crops up in a lot of these lists of very large shareholders of companies. So when your stake in a company exceeds 1%, then your name comes there. So a lot of Rajiv Khanna's stock picks are in his wife's name. Um, Now, he said some really, really surprising things in the conference. Um, I am not, Tamil Nadu TIA is not very comfortable with putting a video of what he said online, but they have allowed me to summarize and report on what he said, and that is what I'm about to do. There is nothing prohibiting me from doing so, but to those of you who want the original video, I'm sorry, I cannot provide that. So, what did Rajiv Khanna say? To begin with, he described his own investing career, his professional career, and his investing career. Right from, he passed out from IIT. He worked in different companies, then set up his own business, and sold that business sometime in the late 90s, and that's when he had a substantial amount of money to invest. And the first investment that he made, he says very candidly, is because his neighbor's son worked in Satyam, and he thought Satyam was an interesting company, and he went and bought it, and that was a dot-com boom. So actually, it did extremely well for him. Then he went and bought more tech stocks, and he made a lot of money in the dot-com boom, and lost a lot of money in the dot-com bust. But the on a net basis, he had still made some money at the end of the dot-com bust, and that allowed him to enter the market in time for the 2002 to 2007, or rather 2003 to 2007 market rally, market boom cycle. Again, he made a hell of a lot of money in that period. 2008, again, he lost some of it, but not enough to undo the full amount of gains that he had made. Moving fast forward to 2016, 17, the run up in small and mid caps. Again, Mr. Khanna did extremely well in that phase. Again, when that segment corrected, he lost out a little bit. We come to the more recent and more interesting bit, which is COVID. So when COVID struck, what did Mr. Khanna do? Well, he says that he sold out early. He saw all of these shutdowns. He felt there would be real damage to companies and their profits, and so probably sometime in March or April, he sold out a large part of his portfolio, and he was not quick to clamber back in when the market rallied. Um, and he says so very openly, very candidly. For people who have made a lot of money, who are extremely successful, there is no reason for them to portray any image of success. So success is there. It's there in the numbers. It's there in their personal net worth. Um, Now, the question is, what is he doing now? He said that his current strategy, he has a portfolio of 500 stocks. His current strategy is to hold on. Every night he goes and checks which are the stocks that are trading above their 30-day moving average, holds on to those stocks. Once they have dipped below that 30 DMA, he sells. And he says this technique, this very simple filter, will allow him to get out of the market before some of this euphoria in mid and small caps stocks gets over. Um, Fantastic. Um, Now, he gives a couple of examples to make the case for active investing over the strategy of buy and hold. He said that Warren Buffett, if you see, his average holding period of a stock is 6 months. He's churning half his portfolio, even at the scale that Warren Buffett is at. So, you and me at our very small scales shouldn't really be an issue because we are not moving markets when we buy and sell stuff. It is a problem for Mr. Khanna because of the size of his portfolio, but not so much for us. And he also argues in favor of special situation investing. He gives the example of, for example, George Soros and the bank, when he broke the Bank of England, when he sold the pound in anticipation of a devaluation. And indeed, eventually there was a devaluation because the pound was not correctly set against other European currencies to which it was kind of benchmarked back then. And there have been other examples, Paulson during the financial crisis 2008, etc. Hedge fund managers who made enormous money in these special situations. So he says that, Mr. Khanna says that you can actually go for, if you can spot one of these situations, they come very rarely, but when they do come, if you go big, you can make a big fortune. Um, so that is the second argument that he makes against the traditional concept of buy and hold investing. The idea that you get rich by buying great companies, holding on to them for very long periods of time. But he is not entirely against buy and hold investing. He says that is just technique one. It is not the only technique, it is one technique. A second technique could be for a lot of people successfully to actively invest, to take some of these short term bets. Now, let's come back to Mr. Khanna. So, is there something else that he's doing with his portfolio? Yes, he said that from until 2018, capital gains, there was no long-term capital gains on stocks, and even the dividends on them were exempt. That allowed him to do a lot of trading or other short-term investing without having to pay a lot of tax. That changed post 2018. Every year he's been setting off his short-term capital losses against long-term capital gains. So it's still, on balance, not super tax inefficient, but there is always the risk of your gains being classified as business income, and then certain restrictions come into play. So although you can set off business income against capital gains, there is inter-head adjustment. Now this is extrapolation, by the way, so he didn't go into the detail of why having your trading classified as business income is bad, but I've talked to some CAs and this is my extrapolation of it, my interpretation of it, that yes, you can set off business income from capital gains. There is inter-head adjustment available in the same year, but when you carry forward your gains and losses, you can't set off this year's business income against next year's capital gains. There is no sort of cross adjustment. Then you can only set off, if you've carried forward capital losses, then you set them off against capital gains, and even there, long-term capital loss cannot be set off against short-term capital gain. It's LTCL against LTCG. STCL on the other hand can be set off against STCG and LTCG. So I think this could be one of the reasons why he's having second thoughts about his current strategy of doing lots of churn, lots of trades in his portfolio. And the solution that he's embarked upon is to invest in mutual funds. Now, why? So when a mutual fund does the same short-term trading inside the mutual fund wrapper, it does not pay any tax, and you do not pay any tax as a unit holder until you redeem your units in the fund. So it's, you can pursue the same trading strategy but through the mutual fund manager. And this is precisely what, for example, Quant Mutual Fund is doing, right? If you see the turnover in his portfolios, it's doing rapid in and out, lots of trading and generating pretty good returns. And in fact, Mr. Khanna seemed to hint, now he didn't use the word quant, so again, please take this with a pinch of salt, but my interpretation is that one of the funds that he's probably invested in is Quant Mutual Fund, because he said that he had bought into a he bought into a fund of low size, and he prefers funds to be of a small size because that allows that trading to happen. So Mr. Khanna is moving some of his portfolio into mutual funds. He's not fully set on that because he thinks that the vast majority of mutual funds practice buy and hold investing, which he categorizes as a test match. They're playing a test match. They're not playing T20, although they have the tax advantage if they do play T20. He feels, and so he doesn't see enough mutual funds implementing his philosophy towards investing. Now, what is my view on all of this? I'm a fan of buy and hold, of long term, of buying businesses, um, which take many quarters and many years to actually grow and thrive. And this is actually technique number one, which Mr. Khanna is in support of. He's he's also in support of technique number two, which is short term trading, which I'm not. So there I differ with him, but let me strongly add a disclaimer here that a lot of respect for the man. Clearly, I will not make money. The kind of money he's made, I will not make in 10 or 50 lifetimes. So my word has no value. My view has no value. His obviously carries enormous amount of weight. But for what it's worth, as a financial journalist, tracking this space for some number of years, I don't think that active investing um, is a good system for most retail investors. Investing in mutual funds for the long term, I think, works for most of us. But that's just my view. Feel free to reject it, accept it. I just feel it's important to state it because sometimes when we journalists, when we report on somebody, especially a big personality, a celebrity, in glowing terms, it seems like we are endorsing what they're saying. And I want to draw the distinction. I'm not endorsing. I respect Mr. Khanna, but I differ from him on approach to investing. So this is it. This the sum and substance of what Mr. Khanna said. You may be disappointed that I haven't put his video on there, but I have to respect the wishes of the association of TIA, and this does cover a lot of the points that he made. So hopefully you found this useful. Thank you very much.